For some of you, because I see some of you who are here, the beginning might be a little bit elementary, but I just wanted to make sure I covered everything for everyone. And I'm going to walk you through a process of the way I see stocks. And I'm going to give you, I have a few actual screenshots of my own portfolio to show you, the value of certain things. So, and if you have any questions, feel free to stop me. If I say something that doesn't make sense, I have no issues with you just chiming in and say, please, can you explain that a different way? Or I don't understand that concept. Because I really want you to walk away being able to do something, at least get started today. So just let me explain my little foray into the stock investing world. I did my first investment in 1990. I had no clue really what I was doing. My first investments were in mutual funds. I kind of lucked out, and it's been a journey for me to really understand stock investing. I ended up taking some high-level courses with a very reputable company. I won't give anybody a shout out, but I took really challenging courses for their pros in terms of people who manage portfolios. And I tell you, I kid you not, it was so difficult. I don't consider myself to be a dumb guy in any stretch. And I failed the exit exam twice before I passed it. That's how thorough this thing was. But I learned so much. I've been able to beat the S&P 500 for years. I mean, by far, 100, 200% more than the S&P 500. So I'm going to show you the techniques I learned that have allowed me to be able to be successful in any market, whether, the economy's up, down, stagnant. I've been able to beat the S&P 500. So like I said, I want to start really fundamental, and we're going to start with what some common myths are, because I think most people shy away from investing in a stock market because in popular culture, there are these myths about what it is and what it's not. So there's a belief that the stock market or investing in the stock market is like gambling, that you just kind of choose certain things and you speculate. And some people are speculative. When you don't have a system, some people do speculate and take these wild chances on stocks. But what I'm going to show you takes all the speculation out of it. And it really is going to walk you through a process of being able to analyze what a good buy is, in terms of ownership of a particular company, why it's good for you, and how you can profit from it in different ways. So it is not gambling if you know what you're doing. If you don't know what you're doing, it is absolutely gambling. If you're just choosing things because you heard about them on social media, if you're choosing things because it's a company you like, if you're choosing things just because you've heard about it, then that is absolutely gambling. But we're going to take the game of chance out of it, and we're going to use well-informed strategies. There's a myth that you need a lot of money to invest in stocks. And I know where that came from. When I first started investing, so I did my first investing in 1990, it was expensive. The barriers to entry were high because to get a brokerage account, usually they made you have a minimum amount in your account. And it was a few $1,000s back in 1990. And every trade was expensive, and a broker got paid whether you bought or sold. So there was a time when it was expensive to get into it. Today, that doesn't exist. The barrier to entry is so low because we have online trading. So you can do fractional trading, fractional shares. You can invest with, I think in many places, $25, right? So very easy to get in, barriers are low. The amount you pay for trades is extremely low. It's really pennies and fractions of pennies now for trade. So you don't need a lot of money. If you have $25, really, you can start investing. Some trades, I think you can trade fractional shares as little as $5, depending on the brokerage. Investing in stocks is only for the wealthy. That was and again, because the barrier was so high, and they were the only ones who could afford it, and really were the only ones who were talking about it 20 years ago, 30 years ago. That's where that idea came from. And when we would see in the movies and on TV, the rich people would all invest in stocks. It is available to everyone, and it is a tool that everyone should become familiar with and use as a part of their strategy for growing wealth. Whether you're talking about long-term savings or whether you're talking about directing it for a specific thing, for retirement or whatever, it should be a part of a portfolio for everyone and not just the wealthy. There's another myth that investing in stocks, that you have to time the market in order to be successful. And actually trying to time the market is a very poor strategy. And nobody can really time it. And it is ultimately a losing strategy because buying and selling and buying and selling, trying to time the market, you lose a lot in fees and you lose a lot in taxes. And you're really trying to chase the value as opposed to thinking of this in a long game, where you're going to have money in it over a long period of time. So I want you to start thinking of the concept of not timing, but time in. So the value in investing in stocks is time in, not timing. So the longer you have it there, the economy is going to go up and down, the greater your returns are going to be in the long run. And the less it's going to cost you in fees and taxes in the long run. There's another myth that you need to be an expert to invest in stocks. I'm going to share with you some resources today that are free. Most of them are free. Some of them are low cost. But if you utilize the tools, you have access to the same information that the people who are working for big brokerages have, right? That information now is accessible and available on your phone, on your laptop. So there's no reason why you can't, and user-friendly too. There's no reason why you can't tap into the same resources and get the same real-time information that they have to be able to make informed decisions. There's another myth that it's all about buying low and selling high. Of course, you don't want to buy high, but the stock market in general tends to go up, and there are dips and go up. But again, it's time in that gets you the real profits, not trying to only buy when it's low and sell when it's high. Matter of fact, I don't really believe in selling in this strategy that I'm going to teach today. I don't believe in selling unless it's absolutely necessary or you're absolutely losing. So the last myth that people have is you need to constantly buy and sell. So that's trading. So I just want to address that. And I actually have a slide for that. But I'm not going to teach you how to trade. I don't believe in trading. Trading is work. Trading is thinking short term. That's a short game. I believe in the long game. When you talk about wealth development, it's not a make a little money today, don't make money, make a little money today, don't make money. It's about consistently making money over a long period of time and allowing this thing to grow passively so that over time it compounds in terms of growth. So I'm not into the trading. I'm not going to teach you how to trade. This is, if you're here for trading, it's the wrong place. This is about investing over the long term. So let me jump into it. So let's talk about why you should invest. And again, in opposition to trading. There's a potential for significant long-term growth. And what I put here was a screenshot. And let me get to that. So you have a potential for long-term growth over a long period of time. And historically, the stock market outperforms bonds, savings accounts, most real estate, most other investments don't compare to the consistent long-term growth of the stock market. And I believe in having a diversified portfolio. I believe you should have real estate. I believe you should have some bond. I believe you should have high yield savings. I believe you should have all these things. But this should absolutely be included in your portfolio because the potential for growth by really doing not much, right? Not having to monitor it much, not having to do much. The potential for long-term growth is incredible. It is also a potential income stream. So depending on your strategy, for me, because of my age and what I'm trying to do, so my whole goal is about financial freedom. I primarily invest in dividend stocks, right? So we're going to talk about what dividends are. Dividends, we're going to talk about, is a form of income that you get from companies that you invest in. So for me, 90% of my portfolio include stocks that pay me dividends. Not only do they pay dividends, sometimes they pay other perks. So I put a screenshot here, and I want you to, if you can see the total return on investment. Now, and I will say this is anomalous, and this is the largest return I've ever gotten in my life. Matter of fact, it's the largest return I've ever seen anybody get. Nobody's ever shown me a bigger return. I got a 4,000% return on investment on this stock. And I'm not suggesting you can get anything near a 4,000% return, but I just wanted to put it here because I didn't initially look for this stock. I got this stock in lieu of dividends that a company I invest in gave. So instead of giving dividends, they bought a smaller company and gave the shareholders of that company stock in the new company they bought, and allowed you for that day to buy some stocks at the price before it went to market. And the price at the time was $1.90. And I think they gave me like 6 shares or something. I said, let me just buy 15 just because, right? I had no research on the company. It wouldn't have been something. I don't usually do IPOs, initial offering. I don't. But they gave me these stocks and the price was so low. I said, let me just take a chance and buy 15. And you can see the market value. I bought it at $1.90 a share. I think it's over $70 a share. I made $1,600 on it, which is a 4,000% return. So just being there gave me this opportunity because I invest in dividend stocks. And again, sometimes they give you dividends, sometimes they give you perks. You can see the phenomenal potential that you can get just from being a part of it, right? Just from being in there and not having to do anything. I didn't have to work hard for it. I didn't have to sit and trade. I didn't have to look at these candle charts and all this other stuff that people talk about on the internet. I didn't have to do any of that. I found a very strong company. That strong company acquired another company and rewarded me for being an investor and owner in their company and getting shares.
What?
Please mute yourself if you don't have a question. Diversification is another reason you should be in here, and I just kind of talked about that briefly in the last slide. You should have a well-diversified portfolio in order to maintain your wealth. So, I know we tend to like or gravitate towards a particular type of asset class. Some people love real estate, and that's all they do. But when the real estate market goes down, because I've been there when we had the big crisis, when the real estate market goes down, you lose everything. Right? Some people will only invest in stocks, and when the stock market goes down, they lose everything. So it should be a part of a well-diversified portfolio. So this allows you to mitigate your risk. And not only does it mitigate in terms of the asset class, but even in that asset class of stocks, there are thousands, literally maybe close to 4,000 different companies that you can invest in. And so if you spread that out, you mitigate your risk of loss over the long period of time. Another reason is accessibility. The barriers to entry are so low today. There's no reason why anyone and everyone shouldn't partake. Again, the cost is low because it doesn't cost you anything anymore to open a brokerage account. The cost of trading is low, or when I say trading, meaning buying or selling, not the act of trading, but the cost to invest is low. You can buy, depending on the brokerage, fractional shares. So you can find a great company that has a high cost per share. Let's say it's $700 per share. And you're like, wow, I can never buy that company because it's too much. You can just buy $5 worth of it and still get the same return on investment that someone would if they bought $700 in terms of a full share or otherwise. So the accessibility aspect of it, to me, is far easier than any other asset class, pretty much, except maybe bonds, right? Or even high yield savings accounts sometimes have a minimum. Real estate, we know the barrier to entry is extremely high for most people. And so the accessibility to this and the ability to grow wealth with just putting in a little at a time, to me, is bar none. There's no other asset class that gives you the type of return for the low level of barriers. And then there are significant tax advantages. Capital gains tax is what you would pay if you sold your stocks. And there's a difference between long-term and short-term capital gains. That's one reason I don't trade. Short-term, you pay, if you trade, you're usually doing short-term capital gains, which is a very high tax, as opposed to long-term capital gains, which is the absolute lowest tax category in the tax system. And it's a scale based on what your earned income rate is, but it goes from zero to I believe 20% or 21%. Based on your earned income level. So most people would pay very low taxes on it as opposed to paying taxes on business tax, corporate tax, right, which is a little higher, and earned income rate, which is extremely high in comparison. So you don't pay taxes on your gains, right? They call them unrealized gains, unless you actually sell. So you can be, you can see I got a 4,000% return on this, and I haven't had to pay a single dime in taxes on it because I didn't pull it out. It's called unrealized gain. So I can allow it to grow untaxed for as long as I needed to. So those are some of the main reasons why any and everyone should start investing in the stock. So let's just start really basic, because I don't think most people know what a stock actually is, right? So stock, also commonly known as a share, when you own stocks, you call it a share. Your amount of stocks you have called share. It's buying a fraction of a company. So a company will divide itself into thousands of little pieces. If you think of it as a pie, it slices itself up and sells ownership of all those little pieces to make the whole. So when you buy stocks, you're actually buying a piece of a company, right? So you shouldn't look at it, and we're going to go over this down in the slides. You shouldn't look at it simply as I'm buying a stock. You're buying into ownership of a company, right? So you're buying a share of a company. So that's what a stock actually is. So there are only two ways to actually profit from a stock. There's what we call capital appreciation, and there's dividends. Those are the only two ways to profit from a stock. So let's just talk about what capital appreciation is. Capital appreciation is the growth in value, meaning the change in the price. So when you look at capital appreciation as a mathematical equation, it's the difference between what it's worth today and what you paid for it. That difference in the middle, right? And in real estate, we call it equity, right? And this, we call it equities, right? You've heard it called equities. The capital appreciation is the percentage that it has grown from the time that you bought it. So again, capital appreciation is unrealized until you actually sell it, right? Because it can come, it can go. It can come and it can go. But the only way to actually profit from capital appreciation, well, there's two ways, I shouldn't say that. The most common way to capitalize on capital appreciation, that growth, is to sell the actual asset. I'm not a fan, again, of selling it, because now you don't have the asset anymore, right? And I'm not saying that there's not a point in time when you don't want to sell it, because that could be your goal. It could be a long-term savings. It could be, okay, in 10 years, I want to buy a house. So I'm going to, instead of putting my money in the bank, I'm going to put it in the stock market, let it grow. Then in that 10 years, I'm going to sell it and take the capital appreciation that I got from it. That could be a strategy for you. So part of it depends on what your strategy. And again, for me, I don't intend to sell anything ever. I intend to let the appreciation, unless I have to, let the appreciation grow. I capitalize on the dividends, and I'll have some assets to pass on to my heirs. So it's a good transfer of wealth also. You can borrow against the value of your assets, but we're not really going to get into that. That's just a little more sophisticated. So what makes a stock price go up? In a nutshell, it's supply and demand. So it's interesting when we watch popular news, and remember during the pandemic, they were talking about the meme stocks, and AMC was one of them. GameStop was another one. These companies were in trouble. They were just terrible companies that were on their way out. And so their stock prices were low because nobody wanted them. Real investors didn't want them because the prices were low. And people who got, mostly young people and new investors who don't understand what we're going to talk about later, which is fundamental analysis, were told to buy. And it became for them almost a self-fulfilling prophecy. Somebody said the prices will go up, buy it, you'll make a profit. And the people who put that information out bought it when it was in the toilet, when it wasn't worth anything. Now, if supply and demand is what makes the price go up, meaning the more people who want it, the less supply of shares is available, that drives the price up. So of course that drove the price up. So people are like, see, we know what we're talking about. The price went up. We're making money. We're making money. Again, unrealized gains. And the company couldn't sustain that because even though they got a huge cash infusion, the GameStop is obsolete. Movies are pretty much obsolete. The companies were poorly run, poorly managed. Of course, the prices came back down because they're poorly run companies and people lost the gains that they got on paper. So it is not proof that a company or a stock is good because the price goes up, right? Because we're talking, again, sustainability, we're talking about long term. If you are a trader, and that's what a lot of them we're trying to capitalize on. If you are a trader and you can influence the market, and that's called the pump and dump, that's a common thing amongst some gurus, and I won't even, I might say some names, but there's some people who own Tesla, I don't say their names, who drove prices up of things, and people were excited and they bought and they saw on paper the prices go up, and of course, boom, they were overpriced and the prices came down. So a high price or prices going up is not evidence that something is a good thing to buy, but it's supply and demand that drives the price. But what drives supply and demand is something that you should consider. So there are certain factors that drive supply and demand. So one of the biggest drivers of demand for buyers, and I'm not talking about, again, the unsophisticated buyer, because they get some simple information and run with it. I'm talking about people who are more sophisticated in terms of analyzing what is a good buy. The health of a company is the number one driver. The health of a company is the number one driver of demand, meaning should I buy this? So what do we mean by the health of the company? And I'm going to give you a factor set later, so we look at the totality. But the company's earnings, so quarterly, the company's earnings come out. Are they showing an upward trend or a downward trend, and why? Do they have a strong or a weak outlook for the future, right? So when we talk about the company's health, those are the number one factors that we look at to determine whether or not this is a good long-term strategy, right? So when we look at some companies don't have necessarily a good outlook because technology has changed and people are moving away from that. So you'll start to see a decline. Or subscription-based companies, you see, a lot of they've reached the peak of subscriptions, especially like streaming companies and things like that. And so you'll see a decline. So there are different things that we look at in terms of the health and the potential outlook of a company. So that will drive demand. Market sentiment, how people feel, right? It's very emotionally sensitive. So you could hear positive news. This company is, the funniest thing for me was everybody's talking about blockchain. You don't even hear about blockchain anymore because who cares, right? Oh, it's the blockchain technology is going to drive everything. Like people got so excited about this news about blockchain that they made investment decisions based on this thing because it was novel and it made people excited, right? So that drove the prices up of other things that we're not going to talk about. But that's when I talk about news. Like you hear certain news, and because it's novel and exciting, people will run with that. And people get confidence in something, even though a company hasn't shown or demonstrated its ability to even capitalize on that. Also, negative news. If you hear about some controversy in a company or a CEO who's leaving, or you'll hear about the CEO who suddenly sold a bunch of his shares. We've seen that, recently. or there's some they're investing in a place that people aren't happy with and people want them to divest, like things like that, or negative news can make a company's value plummet, stock, the demand plummet, and so it drives down the price. So Nike experienced that for a while. So we see things like that. Industry trends and competition. When we look at certain sectors, like we look at microchips, right? So like Taiwan Semiconductor far outperforms the American companies. I think it's one, I forget the name of it now, but one big American company that does microchips, and they can't hang with Taiwan Semiconductor. They're number one in the world, right? So, people will put their money there as opposed to here because of whatever reasons in terms of the competition. They see somebody having a competitive advantage over one or another. So maybe Taiwan Semiconductors is overpriced because of that, and you'll see it differently in the other companies. Interest rates and economic conditions. So when interest rates go up, stock prices tend to plummet because, for a couple of reasons. One, when interest rates go up, people shift their money from what we call equities, which is stocks, into interest-bearing things like bonds and high-yield savings accounts to take advantage of the increase in interest. Also, because of the increase in interest, companies have to pay a higher price to borrow, so they stop borrowing, which stunts their growth. And because they're not growing, then again, remember that was one of the factors in their health. Because they're not showing the same growth, then people lose a little confidence in them as well. So certain economic conditions and interest rates, those are the things that affect the demand. So again, it's only supply and demand that affects price, but the factors that affect demand are primarily these and some other smaller ones. Let's talk about dividends, because I mentioned that. So we understand capital appreciation and what makes the price go up and down. But what is a dividend? Like, a lot of people hear it, but they don't understand it or take advantage of it. So a dividend is basically a company sharing its profits with the shareholders in the form of a distribution of the profits. So a small percentage, and it's based on how many shares you own, right? So they'll have a dividend, what we call dividend yield, which I'll explain a little later. They have a dividend yield, which is a percentage that they offer of their profits or their cash reserves. They're going to distribute it to the shareholders in gratitude for being a shareholder. Dividends are usually paid quarterly, right? So it's not like you get it every month, but every quarter, and it can change, right? Based on the company's profitability, what they pay. So I don't use it currently as an income stream because I have other income, but I'm building up my portfolio so that at some point it can supplement my income streams when I choose not to do any earned income anymore, or when I choose to move out of other areas of income. I use it to compound the growth of my portfolio, meaning all the dividends I receive, I reinvest and buy more shares. So that's a way to actually grow your portfolio without having to come out of pocket. So great, to me, and again, depends on what your goals are. Dividends might not be important to you. You might be looking for huge capital appreciation as opposed to dividends. Because you'll see the companies that pay dividends usually don't have the largest capital appreciation on paper, but the companies that have the biggest capital appreciation on paper tend not to pay dividends. So, and that leads me to this next slide, which is what we call growth stocks versus value stocks. So growth stocks are companies that in general have the promise of big growth in the future. So usually you'll see it's in the technology sector, right? So they tend to be way overpriced because they're saying we're overpriced now, but one day down the road, we're going to be worth a lot. And that drives demand because people are excited about the technology, drives people to pay that higher price up front, which on paper makes their appreciation significant. And if we remember a couple of years ago, Tesla stocks were so high, it was outrageous. Like their price to earnings ratio, which we'll talk about later, was, and just to give you an idea, for a good A good tech company, a good growth stock, the price to earnings ratio should be about 25%. Theirs was 700 something percent, right? So that means they were so overpriced, because people were excited about it. That's their thing. So when we look at companies like that, they have the promise of growth in the future, but they usually be overpriced now. And they take all their earnings and put them back into the company so they don't tend to pay dividends. As opposed to what we call a value stock, you'll see very little capital appreciation. So when we look at Coca-Cola, companies like that, a lot of the like enterprise production, when we start seeing companies that are consumer staples, what we call consumer staples, that have been around for 100 years and probably be around for 100 years. And the technology is simple, right? Coca-Cola is simple. Natural gas is simple for enterprise production. Oil companies are pretty simple. The technology is simple, steady. You don't see a lot of capital appreciation. You see slow capital appreciation, but they usually tend to pay higher dividends. So those are value stocks, meaning they'll maintain their value, where growth stocks, you tend to see these big swings. But you can win. It's possible. It's possible to win, but it's more speculative than value stocks. We talked about investing versus trading, so I don't have to go back to that. So let's just keep it simple for now. Most people don't know where to start, and it starts with choosing a broker. And today, there are so many brokerage houses available, right? There used to be just a handful. So how do you choose a good broker? Part of it is your confidence in the brokerage house, and part of it is its ability to perform for what you need. So I say you should choose a well-established, reputable broker, but I also put Robinhood in this list. So Fidelity is strong and been around for a long time. Vanguard is strong and been around for a long time. JP Morgan been around for a long time. TD Ameritrade even has now, even though they're online brokers, a long time. E-Trade, Charles Schwab. Robinhood has proven itself in the last few years, even though initially it had some major hiccups. It's user-friendly and easy for most people. But if you need other things, Robinhood falls far short of the others. They all allow online trading. They all have apps now. Robinhood kind of gamified it and made it look exciting and maybe a little more user-friendly, but they don't have as much information and they don't have as many products and they don't have the same history that the others in the list have. But I have used it and I will say it has performed at least to the minimum standard, right? You have to ask yourself, do these companies, if you choose a broker, do they have an account minimum? Most do not anymore, but you might run across one. I haven't checked all of them, but most have eliminated the necessity to have a minimum account in order to trade. Then you want to look at their fees, their rates, and their commissions. How do they charge per trade? There are different structures for that and there are different costs for that. So that's something you might want to look at. You want to minimize, obviously, the fees and the rates and commissions. What tools and educational resources do they have? Not as big a deal anymore because there are other resources that you can supplement what they're lacking that are free. So you can get everything you need, but if you want it all in one place, if the tools, different tools, meaning fund screeners and stock screeners are important to you in that one place, if news is aggregated in one place for you, if they have different tutorials in one place, if that's important to you, then you choose a brokerage house there. Otherwise, if they don't have that, you can find those things, but now you got to go to different resources. Do they have different products for different investment goals? Some don't have mutual funds or ETFs, or some don't do fractional trading, So you got to, again, look at what's important for you and do comparisons. There are a lot of places. NerdWallet is a good place to look at comparisons of brokerage houses. Investopedia is another place they have articles on comparing and they rate them and give you, people's feedback on what they found about them. How good is their security? That's important. You don't want a security breach and all your information disappear, or all of a sudden your account is empty also. So those are important things on how to choose a brokerage. The next thing is, once you understand that, is how you actually buy a stock. And I'm going to get into how to choose after we get to this, because this is important. Most people will do what you call a market order, right? And so a market order is, you see the price, you hit the button to buy, and as long as there are, or sell, right? As long as there are stocks available, or as long as there are buyers available, if you're selling, the order will be filled as soon as possible. You can do what we call a limit order, meaning that you want to do it at a particular price. So if a price is at a certain number, you can say, if it hits that number, then I want you to sell, or then I want you to buy. It might not hit that number, so there's no guarantee the order will be filled. You can put in good till cancel, meaning I want this, and keep it there until I cancel it, right? Keep trying it unless I cancel it, so it's good till cancel. You can do what you call a day order, right? So that means you specify the price and the quantity of the stocks you want to buy or sell, with instructions that it should be executed during the current trading day only. If not, then it gets canceled. You can buy fractional shares, which I think is one of the greatest innovations in this whole process. Again, meaning you can buy, like for instance, I have shares in Berkshire Hathaway. Berkshire Hathaway is probably by far the most expensive share that exists in the stock market. Maybe I'll look it up real quick, but just imagine $50,000 a share. Who can buy $50,000? I mean, some people can, clearly. Who can buy a single share at $50,000? But I know it's a good company. So, I bought multiple shares at fractions, right? So I might have bought a couple $1,000s worth of share and got the same return on my couple thousand as somebody who owned an entire share, who owned one share at 50,000, right? So fractional shares, I think, for a lot of people, especially if you only have a little bit of money to invest, still allows you to be well diversified by buying fractions of a multitude of different companies. So we want to eliminate the guesswork. That's what some people do. It's like, oh, I've heard of this company, I think it's good, I'm going to buy it. Or that's a great technology, I'm going to buy it, right? We want to minimize the mistakes by applying a particular method, a system for ourselves that allows us to make an informed decision. And of course, nothing is 100%, because the world changes, things change, the economy changes, companies change, technology changes, those things happen. But it allows you to make a pretty decent purchase up front. And it allows you to monitor your stuff over time. And if some of those factors change, to make a decision to either buy or sell, buy more or sell, right? So it's a system called fundamental analysis. And again, like I said, I trained in fundamental analysis. This is what the big pros use who work for the big brokerage houses who are responsible for huge funds. When you're talking about these, they manage portfolios for millionaires, billionaires, big companies, for unions. This is the system that they use, called fundamental analysis. So I'm going to go through the basics of fundamental analysis and how you can utilize it to start building your portfolio. So one of the primary reasons we use fundamental analysis is to determine not only whether a company is good, but whether the price that is being offered at currently is a good price. Because you can have a company that's great and it can be overpriced right now. And it's funny because we can easily see that with real estate, right? We say, oh man, that's a great piece of real estate there, but they're charging too much because that's not consistent with the fair market value. But most people don't consider what the fair market value or what a good price is for a company, right? So fundamental analysis allows you to understand not only if a company is good and has prospect for profit moving forward, but also is the pricing right currently. So it includes examining the financial health of a company, the management of a company, the competitive advantages of a company, its competitors, and the market, and how it fits in the market. So we're going to do economic analysis, and industry analysis, and company analysis, but there are also other factors involved as well. There are what we call soft factors, there are medium factors, and there are hard factors. So if we talk about the soft factors, and I'm not going to go deep into them because those are things that I'll show you where to find the information for that, because that's somewhat subjective. And then there's medium factors that are not subjective, but that's easily to find. And there are the hard factors, which are really the financials and all that. We'll talk about that. So soft factors are the social responsibility of a company, and if that's important to you, right? Are they environmentally friendly? Are they good to the employees? Are they good to the customers? Are they, things like that? That if that's important to you, right? That's a soft factor. It doesn't necessarily determine how well the company will do, but it will determine if you believe in the company well enough to own a piece of it. If it fits with your values, if it fits with your vision of how a company should run, that's a soft factor. Will the company be around in 20 years, right? So, some of us who have been around a while can remember Eastman Kodak was a powerhouse. And most young people don't even know what Kodak is. And they actually invented the digital camera, by the way, and withheld that technology because they wanted to hold on to film, and others ran with the technology and they could never catch up. Eastman Kodak, when we talk about Hostess, it's gone, right? That was like the premier in pastries and breads and things like that. Even IBM was the personal computer to have at one point, and now like nobody knows IBM for that. There are so many companies. Again, are they going to be around in 20 years? Again, we talk about companies. What was that one with Netflix? Kind of blew them out of the water. People used to go to I can't remember now. It's funny. Go to the video store and they were like #1, right? Nobody thought they would ever disappear because they cornered the market on video rentals, but they didn't keep up with the technology. So are they going to be around in 20 years? What is the management in the company, right? So it's interesting that management styles are changing, and they have to change because the world has changed. So people used to look at Jack Webb as the prototype, and now people are saying he's a monster, like he was only about shareholders and not for the people. And so you look at maybe what they're doing at Google, and how they're treating their workers and things like that. So you look at management, and what they're doing. Are they not overly dependent on another industry? And we saw that with a lot of companies that were dependent on microchips during the pandemic. When there was a shortage of microchips, all of a sudden their profits just plummeted. Companies that were reliant upon a supply chain that had manufacturing in multiple different places didn't have a backup. We saw that that's problematic. And so companies who haven't rectified that, that might be an issue for you, right? And then we have what we call the medium factors. So the medium factors are a lot of things that are out of the company's control and out of your control. So interest rates, right? And interest rates, we know, are manipulated based on the economic health of the country in general. So if we have too much growth, then you have to raise interest rates to slow growth so you don't have hyperinflation. When we're in too deep of a decline, you lower interest rates to spark borrowing and spending, and then they go up. So interest rates is a medium factor. Inflation impact, we saw that, right? So when we have high inflation, again, which will, again, determine interest rates, those kind of go hand in hand. How does inflation impact the product or service that you have? Is it a product or service that the company can only makes money when people have a lot of money and interest and inflation is low? Or is it a consumer staple that everybody needs regardless and it's going to pay no matter what the price goes to? Geography. I remember there was a big boom. People wanted to invest in China, and then now people are withdrawing from China, don't want to invest in China. So geography plays a role. Will you only do U.S. stocks? Will you do foreign stocks? What countries are you willing to invest in? And it's not just geography, it's what's going on there. So is there war happening? Is there political strife? Do they have a stable government? Um, how do they treat investors? How do they treat disputes in terms of lawsuits? Like those things make a difference in terms of geography. Regulatory climate, meaning is it an industry that's on the way to be heavily regulated, right? So we look at some of the fuel industry. We look at maybe even the auto industry. Like, are these things going to change? And so does it make sense to invest in it if you're looking at a long-term trajectory when, there may be regulatory issues that shut that down? What their earnings are quarterly, does that make a difference to you if it's a slight dip, or are we looking at a trend going down or a trend going up? And why? Is it consistent with everything in the market or everything in this industry? Or is it anomalous, meaning it's going down while everything else is going up? And then why? Right? Those are the medium, those are the soft and the medium factors. So to get that information, here are some resources. So these are all online. I'll give you a second, screenshot it or take a photo. You got technology now. Some of you are old school, write it down. So the Wall Street Journal, Yahoo Finance, Bloomberg, CNN Money, Barron's, The Street, Market Watch, NASDAQ.com, USA Today are all good resources. Most of them have a free component and a paid component. You can combine the different ones to get plenty of information. You can do a subscription. If you want, some of them bundle subscriptions, so you can get a lot of information. But for the soft factors and even the medium factors, you can get all the information you need from these resources. All right. Give you another second. All right, so let's get to the hard factors, because this is the scary part for most people, because people are just intimidated by numbers, and it really shouldn't be. Like I said, some of the medium factors are out of your control, right? You just kind of have to understand the impact of the medium factors. The soft factors are pretty subjective, and that's based on how you feel about each of those things. The hard factors don't lie, right? The hard factors are, to me, tell the whole tale of really whether or not you should pull the trigger. It can be great in the soft factors and medium factors, but if the hard factors aren't right, you don't pull the trigger. So let's get these hard factors. They give you an inside look at the financial health of a company, how it's performing, not only how it's performing in isolation, but how it's performing in relation to other things in its sector, in its industry, and in the market in general. How is it performing, and how does it look in the totality of things? It also gives you an accurate valuation of the company, meaning what is this company really worth, and is the price that is being offered at in line with what the company is actually worth? Or is the price, is it a steal, like it's on sale because people didn't look at the hard factors, and just because of supply and demand, it's underpriced right now, so I can buy it on sale? Is it at market price, or is it overpriced right now? And will it continue to be overpriced, so it doesn't make sense for me to buy right now? So those are the things that the hard factors are going to tell you. So these are some hard factors. There are more, but these are some hard factors. And I'm not going to go through the whole list because we'll be here all night, but I'm going to go through some of, I think maybe 4 of what I believe are some of the most important ones. And again, you can research the others if they're important to you. Everybody doesn't look at every hard factor, by the way. We're going to talk about creating what we call a factor set after this. Because if you try to look at every factor, nothing's going to align perfectly. You'll never buy anything. But you have to look at the ones that are most important to you. And I'm going to explain the ones that I think are most important to everyone, or should be important to everyone. So the first thing is what we call the PE ratio, right? And it's what it looks like. It's a fraction. It's the price to earnings ratio. And I'm going to go over that in a separate slide so you understand it a little better. Then we have ROE, which is return on equity. Then we have income growth. Then we have sales growth. Then we have debt management, how they're managing debt. Market cap, or market capitalization, which is the total worth of a company if all the shares were added up. Then we have the dividend yield. What are they paying in dividends? And then we have beta. A lot of people don't look at beta. I look at because, and
Bless you.
please mute yourself if you don't have a question. I look at beta. Beta is volatility. I think volatility, people don't realize the damage that volatility causes. Even in the long term, if you have a lot of volatility, what people don't get about volatility is it takes more to recover from losses than you think in terms of regular math, do investor math. So if, and I just give a little example, every time something drops, let's say it's trading at $10, it's selling at $10, and the price drops 50%. So now it's $5. If I'd need, so that means it dropped 50%. I need 100% to get back to $10, right? I need, and I don't know if you understand that, right? If it drops 50% to $5, if I go up 50%, that's $2.50. I'm only at $7.50. So it takes me twice as much, pretty much, to get back to my starting point from losses. So every time you lose and try to come back, it takes you so much more to get there. So volatility actually kills the value of the long-term investment. So I look at beta, but a lot of people don't. We're not really going to talk about beta, but I think it's an important factor. So let's look at this PE ratio. So price to earnings multiple, it's called sometimes. Price multiple, it's a ratio, again, what is the price divided by the earnings, right? And that gives you a ratio and lets you know what a company is worth in totality. So not to get crazy with it, if I should show you the next slide to make it simple for you, so you don't have to do math. You don't ever have to do math, by the way. The PE ratio for every company is online, right? So you don't, so I'm telling you what it is, and it's extremely important. But you don't have to sit there and do the math to figure it out. You just click on a stock and look at the PE ratio, and it'll tell you what it is. So I'm going to just get out of this technical stuff so I don't intimidate you, and just tell you what a good PE ratio is. All right, that'll make it easier. So currently, the S&P 500, and let me just tell you, so S&P 500 is an index, right? And there are several different indexes. You have the S&P 500, the NASDAQ, the Dow. There are different ones, right? The S&P 500, Standard & Poor's 500 are really the top 500 performing companies being traded in that index. So the average PE ratio right now is 24.79. That means the average company has a 24.79 PE ratio. But what is a good PE ratio is what you have to determine. So if the PE ratio for a value stock, remember we talked about value, meaning it's not going to swing up and down much. It's going to have slow, steady growth over a long period of time. Years ago, people would say, oh, PE ratio of under 16 or under 15 was good. Those days, I think, are gone. For the most part, for most value stocks, under 15 is hard. So if we raise that a little bit and say under 20, then you know you have a good PE ratio, meaning the company is valued pretty much at what it's worth, right? So the fair market value is decent. So I gave a couple of examples from my portfolio. Enterprise Production, which I love as a value stock. And I'm not saying buy it because you might not get it at the right price, right time, it might not fit your portfolio, has a PE ratio of 11%. Right? So that's a good buy as in comparison to Coca-Cola, which everybody knows and loves, which is a part of my portfolio. But I think it's overpriced now because the PE ratio is 25. So it's for a value stock, again, if we're looking at under 20 and Coca-Cola is selling at 25 now, I think it's overpriced. You might not think so because you might say, I just want to get it in my portfolio. And because I'm not going to sell it anyway, and I'm looking for dividends and not capital appreciation, I'm going to buy it because I want the dividends, right? So it doesn't mean don't buy it, right? Because there are, again, multiple factors we're going to look at. But know that you're probably paying a little more than the market value if you're buying a value stock and the PE ratio is over 20. And then we look at the growth stocks. Remember, the growth stocks, are more speculative, right? It's like we know we're spending a lot of money, we know we're asking a lot, but we're reinvesting every dollar into this technology, and down the road, it's going to pay off for you. And we're going to show you tremendous capital appreciation. We don't pay dividends, but we're going to do tremendous capital appreciation. You want to get a growth stock because they tend to be, we call overpriced anyway, under 35, right? So the PE ratios tend to be higher. If you can get it under 35, then it's usually you're not overpaying for that. So again, I looked at things out there. If you look at Google has a PE ratio, and Google I think A and C, they have two different offerings. Google, their PE ratio is 26. Right, so at 26, that means it's not overpriced currently. But when you look at NVIDIA has a PE ratio of 76. So when we look at what's the difference, 2 years ago, you could have bought NVIDIA dirt cheap and it was losing. It was losing like crazy. But NVIDIA is one of the premier companies pushing AI. And since everyone is excited about AI, they're like, dump the money into NVIDIA. Again, remember, supply and demand. So it drove the price of NVIDIA up, even though they haven't changed much. They just one of the companies that are big in AI. So people are excited about AI, drove the price up. So now the PE ratio is 76. So personally, I think NVIDIA is overpriced. And again, it's a personal thing. Do you think, okay, based on their price in relation to their earnings, they're not earning that much. It's 76 times higher, right? They're earning their prices, if you broke it down by share, 76 times higher than what their earnings are. To me, that's too much. But you might just want to own a piece of NVIDIA for whatever other reason. But again, if we look at multiple factors, this might not exclude it for you if other factors make sense for you. So that's the PE ratio. Then we want to look at income growth, right? So we want to look at overall income growth on a cash statement, meaning we want to look at the trend over a number of years. But we want to look at income growth, we want to look at their net income, because that's important, not gross, net income, cash flow from operating activity, and free cash flow, money that's available. So we want to look for upward trend of about 10% annually. So if we see every year they've been growing about 10%, okay, that's good income growth. And that shows they have a trajectory, a long-term trajectory of growth. Then we want to look at their debt ratio. This is important, right? People don't look at debt. Debt ratio is the total debt to total assets. So if you put it, it's like for an individual net worth, right? What's your net worth? You put your debt on one side, you put your assets on the other side, and that will tell you what the ratio is. So total liabilities divided by total assets will give you the number. You don't want, right? So we don't want a debt ratio greater than 1, right? Because that means that the debt is funded by the assets. So we want a ratio below 1 means that it's a good debt ratio. So I'm not going to go, like I said, through everyone, but let me just show you what, I'm sorry, in the dividend yield, this actually should have been a slide before. For a dividend yield, I like a dividend yield greater than 3. So again, I put something, this one is actually, I think it's Enterprise Productions. The dividend yield on this is, even though they have a high PE ratio, right? So I wouldn't buy it now. The dividend yield is 8.3%, right? So it pays me a high dividend yield. So would I buy it today? Probably not, because I'm buying it overpriced, or I might because the dividend yield is so high, I believe I can make it up, right? So we want to look at a dividend yield over 3%. So where can you find all this information? There are stock screeners. I think these 3 up here are free, but they might have ads pop up every once in a while, which can be annoying. Finviz, the ads pop up like every 10, 20 seconds unless you pay for it. Wall Street Zen is pretty good and free. And some of these other ones you have to pay for, right? But what does that mean? You can put in every one of your factors that are important to you, PE ratio, debt, all these things. You can plug it in, hit a button, and it'll show you all the stocks that meet your criteria. And then you can start manipulating certain things in your criteria to make the list longer or shorter. So you want to create a factor set, meaning you want to create a list of things that are important to you in the soft factors, medium factors, hard factors in making your decision. You don't want to make the factor set so long that it excludes every company, right? So you might choose 10, you might choose 15, maybe even smaller. You can do what we call top down, meaning you start with your soft factors and work towards your hard factors, or you can do bottom up, meaning you plug in the financials and then see if they meet some of the soft factors. So you can go either way. You can start soft, you can start hard, but you got to start somewhere. So I'm going to give you a sample. This is a sample factor set. This is actually the factor set that I personally use. But again, you can take some out, you can add some, you can, it can be all kinds of stuff. So when we look at this as a factor set, is it going to be around in 20 years? Is it not trendy? Does it have the ability to adapt? That's important to me because, again, for me, I'm looking at long-term. And long-term is different for everybody. Again, I never plan to sell unless I have to because I want to be able to pass this down to the next generation. Is the leadership committed and competent? And not when I say committed, I'm talking about committed to the health of the company and the people who work for it, not to the shareholders, because management that's committed to shareholders lead a company, just walk on the employees, walk on everybody. Don't really care about the customers, just care about profiting the shareholders. I'm not interested in a company like that. Are they a market leader, meaning they have a strong competitive advantage in their industry? That makes a difference because more people will probably continue to buy from them over the long term if they have a competitive advantage. Are they not under regulatory threat? That's important to me. When we just an aside, when we talk about business, I used to be in the hostel. I used to be in the hospitality industry. I used to have hostels before the Airbnb trend took off, and that industry got regulated out of business, and so did Airbnb eventually when they began to enforce it. Because in New York City, you can no longer have transitional housing in an apartment building. In New York, an apartment building is 3 units or more. So you can actually, a company can be pushed out of business because of regulatory issues. So is it under regulatory threat, right? So is the company you're investing in a regulatory threat? So I look at the PE ratio as a hard factor. Again, for value companies, under 20%, for growth companies, under 35%. They have to fit that for me. We didn't talk about return on equity, but a return on equity of greater than 12. Income growth of 10% plus, sales growth of 10% plus, a debt ratio less than 1, right? A market cap, I only like to deal with large cap companies, which are huge. I believe it's over $1 billion because they have the ability to withstand economic downturns easier than mid cap or small cap companies. A dividend yield for me, because dividends are important, of 3% plus, and a beta of 1 or less. I don't like volatility. So you'll create a factor set for yourself that you will use. And if things fit your criteria, that's how you'll populate your portfolio. So let's be honest and talk about risk because every investment comes with risk. However, if you understand the risk, the historical risk, and even the potential risk based on the way we're moving forward, because we didn't have climate change risk before, which is major now. It's a major impact on a lot of different industries. If you look at historical risk, things that provided a challenge, and we look forward to the potential risk, it allows you to make better decisions moving forward and to minimize your risk by taking certain actions. So there are 2 major types of risk when we talk about investing in the stock market. Here's what we call systemic or systematic risk, or unsystemic or unsystematic risk. So what's the difference? When we talk about systemic or systematic risk, that means everything is in trouble. The entire stock market is cooling. And we see that when we have economic decline, right? So when we're headed toward a recession, again, when interest rates are high and it cools the market, when we had the pandemic, right? When we have these things that have a major impact on the entire economy, that's what we call systematic risk. So the goal when we have that systematic risk is to not be in the things that are most vulnerable to systematic risk, right? So um, things that are affected most are the things that people don't need the most. So when you talk about high ticket items, cars, furniture, um, um, travel and tourism, when we talk about technology, right? When we look at these companies, they're most at risk when we talk about a major downturn in the economy. So you want to kind of shift your portfolio. You want to rebalance, we call rebalance your portfolio to move it into consumer cyclicals and what we call consumer staples, because those things usually can endure, right? So we talk about energy. People, you're going to need fuel for your car. You're going to need fuel to heat your home, that whether it's gas or oil. You're going to need um, uh, uh, food, right? So General Mills tends to do well in it. You're going to need pharmaceuticals. There's certain things that I don't care how bad the economy gets, you can't do without. So the health industry still does well because most people in America are sick right now. So there are certain things where you want to be, right? And those tend to be, again, the value stocks that do well during economic downturns. And those, again, are the things that, even though they're not showing capital appreciation, will continue to pay you dividends during the economic downturns, where you'll see your capital appreciation disappear in the growth stocks because people just can't afford to purchase those things. So when you see that systematic, and I'm not saying sell what you have in the value stocks. I'm saying if you're continuing to invest, you just shift it to make it heavier in the area that's going to be sustainable, as opposed to putting it in the growth stocks that are going to see a loss of value during that time. So that's systematic. And then we have unsystematic or unsystemic risk. And that means it's unique either to the specific company or that specific industry. So we might see, again, when we had the chip shortage, television sales went down, refrigerator sales plummeted. All these appliances, we saw, high ticket appliances plummeted because there was a shortage of microchips. So that's something in an industry. You might see it in a particular company because they're going through some type of transformation or some type of change, whether it's a management change, a change in their vision, a change in demographics. We saw that with Peloton. Peloton was blowing up, and then all of a sudden, boom, it plummeted in that industry, in the health industry, in the fitness industry. They just plummeted because of some changes that they made. And so we'll see that. So labor problems, we saw that Amazon's had some issues with that. Walmart in the past had some issues with that. Where what's this? The coffee company, Starbucks is having issues with that. So we'll see issues with labor where they either want to unionize, they want higher wages. We see that a lot in the fast food industry right now, right? So you're seeing these adjustments happen there. It could be, if it's a foreign company, nationalization of the assets. We saw that, we see that in companies where there's a change in the regime and they might take over companies that were private and they nationalize them. So we'll see that sometimes with big companies, oil companies and things like that. It could be weather conditions. Again, we talk about climate control. Anytime there's a hurricane, especially in the Gulf region, where they refine oil, we see, the prices in oil go up, but the value of the companies go down, right? Because they can't produce. You again want to reduce this risk by being well diversified, not only in a particular industry, but across industries as well. So diversification is the key, meaning we don't want to put our eggs in one basket. For me, to start with a portfolio of at least 10 stocks that are well diversified in different sectors and different industries, and maybe, a couple of companies in the same sector, same industry, you'll do better in the long run than you will of, I like Microsoft, I'm going to put all my money in Microsoft. And then when Microsoft goes through its challenges, you either win or lose it all. Not a good long-term strategy. So let's talk about some other risk mitigation techniques. You can do what we call a stop loss for your stocks, meaning that you put in advance in order, if I lose a certain amount, stop the losses by selling this thing immediately. It will trigger the system to sell, right? And so that's a way to mitigate losses because this way you don't have to pay attention already, right? You're like, okay, I know this is a risky industry. You don't necessarily have to do it for everything. And some things will bounce back because it could be systematic, right? But for unsystematic things that are a little more risky, a little more volatile, so that you don't lose, you have a stop loss. And when it drops a certain amount, it triggers the sale to stop the losses. You can have what we call a trailing stop loss. So the floor changes, right? Instead of having it at a specific place, trailing stop loss, as it goes up, that is still a percentage, but the number it triggers to sell at is different. It actually ends up higher. Most people do a trailing stop loss at 25%. So if you lose 25%, it triggers a sale. You can mitigate also by what we call dollar cost averaging. So instead of watching it every month, if you just buy the same amount at the same time every month, you'll get some at a higher price, you get some at a lower price, but it'll average out a net gain in the long term. So those are some ways to mitigate loss. So I said a lot, but of course, I want to offer you a lot more. I want to do a 4-part. I've done this course before, but I only did 3 sessions. I think adding a session is important because I want to be able to get in a little bit more. So I have a 4-week course that I'm going to offer that's going to begin on May 22nd. So it's going to be 4 consecutive Wednesdays from 7 to 9. Of course, you'll get the video recordings and the class slides. I'll give you an investing resource list. So all the resources you'll need to be able to be successful, I already have them all written out. You'll get that. You'll have action steps on what to do every week. But the most important thing is we're going to build a portfolio together. So what we're going to do is I'm going to break you into teams, and everybody will get a set of stocks in their team. Everybody will be responsible for analyzing that set of stocks. And at the end, we'll put it all together and build a portfolio on paper, and you'll get to choose whether or not you want to actually buy those things. And I'm going to share something with you in a minute because time in is important, right? So to get started, the sooner you learn the skills and the sooner you get started, the better. But I just want to share this slide. This is the portfolio I actually created with the class. So I created a separate portfolio for the class, and the class was in 2021. That portfolio that I did in 2021 has netted me 36.21% return. That's because we used fundamental analysis. Everybody had their piece. We put it together, eliminated things that didn't make sense. And that same portfolio, I put it together and just sat it there. Didn't do anything else with it. I can't say I did. I rebalanced a little bit when the economy changed. And it's netted me year to date, you can look at 36%, which is far better than the S&P 500, which is far better than the index fund, which is far better than any real estate most people ever bought, which netted me $5,000 for doing absolutely nothing, right? So you have to ask yourself, to be able to get the skills to put together a portfolio with other people to use the skills where I'm guiding you through it, what is it worth? For me, I taught the class and it got me $5,000. So what would you pay to be able to get the skills to be able to profit from it, the skills, the tools, and the resources and the support to profit from it for the long term? I don't know when the last time many of you got a 36% return, but it's well worth the investment in a 4-week course. So let's get to it. Of course, if you could make $5,000, it would easily be worth $5,000, but I'm not going to charge $1,000, not $500, $399 for the course. I give you 100% money back guarantee, meaning no questions asked. You can take all information and use it and make money, and I give you a full year, and you just say, I want my money back. You can destroy a relationship, but that's cool. But you can get your money back, no questions asked. It's only $399, and I'll let you. There's a payment plan. You can pay it all at once. You can pay it in installments, 3 installments over 3 months, or you can pay it in 2 installments over 2 months. But the class again starts on the 22nd. and I'll walk you through every little aspect. I try to give you the enough to get something started now, but of course, there are many nuances that we're going to walk through, and we're going to do this together. We're going to go on the fund screeners together. We're going to plug in the numbers together. We're going to analyze everything together, so you can start building a portfolio and have that information. So if you're ready to go, and again, it's only $399, you'll make that up in no time in your portfolio. There's a registration form that you can fill out. This is the form. I don't know. Let me see if I can put that in the comments. Can I put that? If not, screenshot it, please, or just write it down and type it in. Let me see if I can put it in the chat. Oh, can't paste it in the chat, can I? All right, maybe I can type it in the chat. Okay. Are there any questions, comments, or concerns? No questions? Oh, you guys must be ready. Not a single question? Was I that thorough? You flatter me. Okay. There goes. So that's the link. Okay, so somebody asked, how do I feel about REITs? Okay, so I didn't get into funds. I'm all for REITs. So a REIT is a real estate investment trust. And they have to pay dividends, by the way. And many of them pay actually monthly instead of quarterly. They come and go with the real estate. So they're tied to the real estate market. So as the real estate market goes up, they tend to increase in value. But REITs, and then of course, we're going to talk about REITs. We're going to talk about ETFs, which you didn't get a chance to talk about, which are exchange traded funds. We're going to talk about index funds. We're going to talk about mutual funds, all the different structured investments that you can do that allow you to diversify a portfolio. And it's really creating leverage by putting in a small amount and getting a good return. So I love REITs. I love many of the, I own a REIT. I like many of the structured funds that exist. Any other questions? You can unmute yourself and ask too. You don't have to type it in. No other questions? All right. Questions are going to be going once, going twice. All right. Going once, going twice. No more questions? All right. So I appreciate you coming out tonight. Hopefully there was some value for you. So again, I appreciate you coming out. Everybody have a great night, and I hope to see you in the course.